Welcome back to the deep dive. Today we are taking a scalpel to something that, on the surface, sounds maybe a bit mundane, apartment association governance.
Right. Doesn't sound like the most thrilling topic initially.
Exactly. But what we're actually investigating here is, well, it's a high-stakes failure. We're talking multi-core public funds, systemic governance collapse, claims of criminal breaches, and a really stunning asset sale, one that effectively confiscated about a decade's worth of market appreciation from an entire community.
Yeah, it's a critical case study, really. We're diving into the VVARWA, that's the Vasant Vihar Apartment Resident Welfare Association.
The VVRW? Okay.
And the documents we've synthesized, they really show how poor governance isn't just like administrative oversight. It's a direct pathway to serious financial and legal harm.
Serious harm.
We're looking at an association that, according to one very detailed report, has spiraled into what it calls an ugly legal situation.
An ugly legal situation.
Yeah.
Okay, let's unpack this right away. Our sources today are two incredibly detailed, highly critical documents.
Yes.
We've got an internal audit critique submitted by a homeowner. Chandra Nath seems quite diligent.
Seems so.
And then there's a comprehensive legal memorandum. It forensically dissects this single, apparently illegal asset alienation.
That's the core of it, yeah.
So our mission, listener, is a quick but thorough synthesis. We need to go beyond just the headlines, understand not just what specific transactions went wrong,
Right.
but how this culture, the systemic governance failure, actually allowed such a dramatic, maybe even criminal alienation of common community assets to happen.
And crucially, what specific legal recourse is available? Like high leverage recourse right now.
Exactly. What can actually be done?
Precisely. This whole narrative, it really connects the dots between, an entrenched management structure and what amounts to a financial catastrophe.
Yeah.
We have evidence pointing pretty clearly to what's described as an unhealthy oligarchy.
An unhealthy oligarchy. Okay.
And an audit process that was, well, called purely a formality.
Just ticking boxes again.
Seems like it.
Yeah.
And then there's that single, very significant transaction involving common land, the one that caused the whole community 12 years of compounding market appreciation.
12 years of growth just gone. Poof. A loss of value. Assets that should have really bolstered the community's funds, the corpus, for decades. That's a staggering financial injury.
It really is.
So we're going to start by scrutinizing the culture of power first. How the governance structure actually enabled this opacity.
Makes sense. Start with the environment.
Then we'll move to the hard numbers, the stuff in the audit critique that reveals the internal confusion and lack of oversight.
The financial nitty-gritty.
And finally, we'll dedicate, I think, substantial time to analyzing the staggering legal liability. Who's on the hook? The management committee, the MC, the builder, and, of course, the beneficiaries of this illegal sale.
Yeah, there are multiple parties potentially facing serious consequences here.
Okay, let's start with the atmosphere then. The environment that let this whole failure, well, flourish. The reports consistently say the fundamental issue isn't just, a lack of money or simple bookkeeping mistakes.
No, it's not about arithmetic.
But a grave concern on governance culture. That's a direct quote. So what kind of climate are we actually talking about when it comes to the leadership there?
Well, we're talking about a system that seems defined by concentrated power and really an active resistance to genuine oversight.
Active resistance.
Yeah. And the situation is particularly complex because of the association's specific demographics. What's kind of fascinating, but ultimately corrosive, is the social engineering that seems to be at play.
Social engineering? How so?
The critique explicitly notes what it calls an unwritten rule. Apparently, this rule limits who can hold the highest office.
Oh.
Only individuals of senior military rank, specifically brigadiers and above, are allowed to become president.
Brigadiers and above only. Wow. Okay. I can sort of understand the instinct there, maybe. Desire for a proven discipline, leadership, given the association's background.
Sure, on the surface, it might seem like a good idea for stability.
Right. But how does that unwritten rule, designed perhaps to promote stability, actually lead to what the report calls an unhealthy oligarchy?
Because it immediately narrows the pool of potential leaders massively.
Yeah.
And more importantly, it installs a hierarchy that seems built more on deference than on democratic accountability.
Deference, right. People might be hesitant to question a brigadier.
Exactly. It entrenches an oligarchy because it sort of presupposes that only this one very narrow class of individuals has the necessary skills. It doesn't matter if there are other competent civilian homeowners available.
So it undermines the whole idea of homeowner democracy.
Totally. The core principle should be the best candidate, the one most willing to be transparent and accountable, gets elected. But when a specific, narrow, and often, highly respected group holds mandatory control, the natural tendency for maybe junior folks or non-military homeowners is just to defer. And accountability just withers in that kind of culture.
Okay, so accountability withers. And when that accountability is challenged, which it sounds like some diligent homeowners tried to do, how did the ruling establishment, as the report calls them, react?
Well, the documents make it pretty clear. The hostility to transparency seems pervasive.
Pervasive hostility.
Yeah. Constructive suggestions, often, fact-driven questions, demanding clarity on finances or why something was done. They weren't just dismissed.
No.
They were repeatedly ignored or all too often treated as irritants by the ruling establishment.
Irritants. Asking where potentially millions of rupees are going is an irritant.
Apparently so. They were seen as an inconvenience, maybe even a threat to the established order, rather than, legitimate input in a democratic body.
Wow. Calling a valid question an irritant, that already tells you the governing body has put its own comfort, maybe its self-preservation, above its actual responsibility to the community.
It certainly suggests that.
This breakdown, it's really the essence of a fiduciary breach, isn't it? If they're ignoring questions about how they're managing millions of rupees of other people's money, how does that specifically violate their core legal duties?
It's fundamental. Fiduciary duty, it boils down to three main things. The duty of care, the duty of loyalty, and the duty of prudence.
Care, loyalty, prudence.
Okay, when the president and the MC obstruct transparency or actively ignore their statutory obligations, rules they're required by law to follow, they're pretty much violating all three.
All three.
They are legally and morally entrusted with managing the community's multi-core public funds. Obstructing oversight isn't just bad management. It's a prima facie violation of that duty of loyalty. It suggests they're prioritizing their own convenience or maybe even concealment over the financial safety of the homeowners they represent.
So their number one legal obligation is to protect and manage the assets. But by resisting oversight, operating in the dark, they're actively putting the funds and the community assets at risk.
Exactly. And maybe the most alarming perspective offered in the source material is how the MC seems to view its own compliance obligations.
How's that?
It looks like they regard following the law, adhering to regulations, as an unnecessary irritant, something to be complied with only if a homeowner compels the MC by taking them to court.
You're kidding. They're basically daring homeowners to sue them just to get basic compliance.
That's what the analysis suggests. They're daring people to litigate things that should be standard operating procedure.
But hold on. Given the cost, the time involved in fighting a well-funded, entrenched MC, how realistic is that for an average homeowner? It sounds like the system is almost designed to favor the existing oligarchy through just sheer inertia and expense.
That is precisely why this kind of culture is so dangerous. The MC is likely banking on that inertia, on homeowner exhaustion, and the prohibitive cost of legal battles.
Yeah.
But the consequence of their resistance, it far outweighs the cost of just complying in the first place. This resistance erodes their legal legitimacy, puts crores of owner funds at risk, and critically, it exposes the office bearers themselves, the president, secretary, treasurer, to personal liability.
Okay, let's dig into that personal liability for a second. If the MC acts in a way that causes the association financial harm, how does the RWA structure, which is usually registered as a society or cooperative, right?
Yeah.
How does that allow for the corporate veil to be pierced, to make individuals personally responsible?
Right. That's a key legal point, and it's crucial for you, the listener, to understand. Usually, yes, a registered society offers some protection. The idea is the association, not the individual office bearers, bears the liability.
That's the veil.
Exactly. However, that protection isn't absolute. It can dissolve under certain circumstances.
Like what?
If the actions are proven to be ultra vires, that means beyond their legal power, or if they involve willful misconduct, gross negligence, fraud, or an intentional breach of fiduciary duty.
Which sounds like what's alleged here.
It does. Facilitating an illegal asset sale, falsifying accounts. If these things are proven, a court can absolutely hold the individuals personally liable for the losses incurred by the association.
So they can't just hide behind the RWA structure.
Not if they're shown to have engaged in activities detrimental to the owner's interests, especially for personal gain or through deliberate, malfeasance.
That really raises the stakes for every single person who signed off on these questionable transactions. Now, beyond the breaches of fiduciary duty, the sources point to maybe an even deeper structural issue. The current organizational structure itself might even violate the Societies Registration Act, 1960. What kind of catastrophic consequences could flow from the association being improperly constituted in the first place?
Okay, this is potentially a foundational legal disaster. If the RWA isn't constituted legally, or if its own bylaws violate the core provisions of the Societies Act, it puts the very legality of the MC's authority to handle funds into question.
Their basic authority to operate.
Yes. The source explicitly warns that this risks crores of owner funds being handled without statutory authority.
What does that mean in practical terms? Can they still, pay bills, sign contracts?
Well, if the MC is operating without proper statutory authority, its legal personality, its ability to act as a legal entity, might be compromised. So any contract it signs for maintenance, security, big capital projects could potentially be challenged later and maybe even declared void.
Oh, wow.
Furthermore, if they need to sue the builder, for instance, or if they get sued by a vendor, their actual standing in court could be questioned. It shifts the problem from just bad management to potentially illegal management.
They become like a ghost entity managing millions.
In a legal sense, potentially. A body managing crores of rupees that might not legally exist in the eyes of the registrar or the courts. That creates a huge vulnerability for all the members and their assets.
Okay, that context regarding legal authority and the governance culture is, well, it's terrifying, frankly. Let's move now from those structural failures to the financial evidence, starting with the audit itself.
Right, the numbers.
The Chandra Nath submission, the homeowners' critique, it introduces this review of the FY 2024-25 audit. It calls it technically compliant, but substantively lacking. What exactly makes an audit by a firm like BN Subramania & Co. just a formality audit?
A formality audit, basically. It achieves the bare minimum required. The auditor checks if the arithmetic adds up,
Debits equal credits.
Right. And that the documents the MC provided seem to support the balances stated in the books. They issue a true and fair opinion, but it's based solely on the records they were given.
So they don't dig deeper.
That's the problem. They completely fail to apply what you call governance-grade scrutiny. They don't look at the effectiveness of internal controls. They don't check compliance with the association's own bylaws. They don't question the rationale for major financial movements.
It's an audit of the books, not an audit of the responsibility.
Exactly. It's not auditing whether the MC is fulfilling its fiduciary duty.
Okay, so let's look at the specific numbers then, the ones that reveal this opacity. Because homeowners have fundamentally the right to know source and application of funds and the right to audit trail. What are the specific figures that just lack transparency here?
Well, we see significant fund reductions that are just unexplained. For instance, the Crucial Project Fund. This is money supposed to be earmarked for specific future developments or major capital works.
Right, like repaving or a new roof fund.
Something like that. Well, it dropped sharply. From INR 45.24 lakh down to INR 28.1 civ lakh.
That's a drop of over 17 lakh rupees from a dedicated fund.
Correct. And the accounts offer no detailed narrative, no explanation of where that money went or what specific project actually consumed it. It's just gone from that fund.
And this wasn't just limited to the project fund, right? These unexplained movements.
Yeah. No, not at all. The accounts document multiple transfers between various internal funds, project, corpus, asset accounts, again, without explanation.
Just shifting money around.
Apparently. And crucially, these transfers are listed almost like rote entries. Often they lack any reference to a resolution, either from a general body meeting or even an MC meeting, and no explanatory notes detailing why it was necessary or who authorized it.
So if the MC shifts money, say, from the long-term corpus fund into the short-term project account, they need to justify that.
Absolutely. They need to provide the legal authority and the reason. When these transfers just appear as routine entries without any backing documentation, it strongly suggests they might be moving money around to cover shortfalls or maybe facilitate transactions without getting proper democratic input.
Okay, and that lack of clear segregation, it leads directly to another issue raised, commingling funds, specifically around the interest earned on fixed deposits.
Exactly. So the association earned a significant amount in interest, INR 28.65 lakh.
Nearly 29 lakhs in interest.
Okay. But this interest income isn't itemized by its source fund. Think about it. If you have a sinking fund FD, the interest earned belongs to the sinking fund. If it's a corpus fund FD, The interest belongs there.
You can't just pool it all together.
You shouldn't. When they improperly lump all the interest together into one pot, it risks the unauthorized commingling of these earmarked funds.
Why is it so bad?
It's a crucial procedural failure because once that interest gets mixed into a general ledger, it becomes much, much easier for the MC to potentially use capital reserves or long-term growth funds for just routine maintenance expenses. And that artificially inflates their apparent operational performance. Makes it look like they're running things better than they are.
Right, masking underlying issues. This sounds like a structural flaw that almost deliberately enables opacity. Which brings us to the, frankly, astonishing structure of their investments, this opaque FD structure. How complicated is managing over 40 fixed deposits?
It's not just complicated, it's an active managerial hazard. The report says the association holds over 40 fixed deposits spread across 3 different banks.
40 FDs and 3 banks.
Yeah, and the complexity is massively compounded by 3 critical omissions. First, there's no consolidated investment register provided to members.
No single list of all the FDs.
Apparently not. Second, no maturity schedule. Homeowners don't know when these FDs are supposed to mature. And third, absolutely no written investment policy guiding how these funds should be managed.
It sounds less like prudent fund management and more like trying to manage your entire life savings using like 40 different small wallets hidden in 3 different houses. It's chaotic.
That analogy is pretty much perfect.
What does this level of complexity and lack of transparency actually enable?
Well, the documents state quite clearly that this lack of transparency enables premature closure or round tripping.
Round trip?
Think about it. If the MC suddenly needs, say, 10 lakh for some expense they maybe don't want scrutiny on, they could quietly break one of these 40 FDs before its maturity date. Since there's no maturity schedule or investment policy known to the homeowners, nobody's really monitoring the status of each individual FD.
So they can break it, use the money.
Exactly. Use the money and then potentially round trip it, meaning replace the principal amount later, maybe from another source, hoping no one notices the lost interest or the temporary gap.
Or maybe they just don't replace it at all.
Or not replace it at all. And without a clear register and schedule, it's incredibly difficult for any homeowner to trace that movement or even detect the loss of interest income. It's basically a mechanism for masking short-term fund diversion.
Okay, let's pivot now to the sort of summary of structural failures that collectively conceal the true financial picture. The report lists 5 critical transparency deficits. If these were corrected, it sounds like concealment would be almost impossible. Let's start with the most foundational one.
Okay, number 1, the absence of a cash flow statement. This is huge. They provided neither the standard receipts and payment statement nor a proper fund-wise cash flow statement.
And why is a cash flow statement so essential?
Because it shows the actual movement of money. Where did the cash come from and where did it actually go? The balance sheet just shows a snapshot in time. The cash flow shows the journey.
Okay, and why does the lack of a cash flow statement specifically conceal potential encumbrances on those FDs?
This is critical. Without a cash flow statement, you only see the final balance of the FDs listed on the balance sheet as assets.
Right. Looks like money in the bank.
Exactly. But you don't see if those FDs have been pledged as collateral against, say, a bank loan. That's an encumbrance.
So the RWA could secretly take out a loan?
Potentially, yes. If they took out a loan and used some of those FDs as security, the balance sheet would still show the full face value of the FD as an asset, but the cash flow statement would reveal the loan coming in as cash and the corresponding liability. You would also ideally note the pledge against the FD.
So by omitting the cash flow statement,
the MC effectively hides potential hidden debts, these contingent liabilities, and seriously threatens the actual liquidity of the association. The money might look like it's there, but it could be locked up.
a major hidden risk. Okay, what's the second structural deficit identified?
Number 2, the absence of schedule narratives. Basically, figures are presented in the accounts just as numbers, without proper cross-references or detailed supporting schedules explaining them.
What does that mean in practice?
In proper institutional accounting, almost every significant figure on the main statements should have a supporting schedule or note. It provides the breakdown, the narrative. For example, if the audit lists security expense, 25 lakh, there should be a schedule detailing which vendor was paid, the period covered, maybe the contract reference.
A little bit that.
Without those narratives, the members simply cannot trace the usage or purpose of the funds. It completely breaks the audit trail, making it impossible for anyone to independently verify the legitimacy or even the necessity of any major expenditure.
Okay, And the third deficit. This one seems to expose the failure of the external auditor themselves.
Yes. Number 3, no independent verification. The report states the auditor explicitly relied only on the books, records, and documents provided to them by the MC.
They didn't check with anyone else.
Apparently not. They failed to seek third-party confirmations.
Yeah.
That means basic stuff like asking the banks directly to confirm the account balances independently, or maybe reaching out to major vendors to confirm outstanding liabilities or payments made.
Isn't that like standard auditing practice? Auditing 101.
Absolutely. It's fundamental. By relying solely on the MC's internal records without any external verification, the auditor creates this massive risk of unverified or, even worse, potentially fictitious balances being reported.
Fictitious balances. Wow.
They're essentially just signing off on the MC's word, not on independently verified reality.
Does the auditor face professional liability for such a basic failure, especially with multi-core funds involved?
Oh, absolutely. If this audit is proven to have been conducted negligently, falling so far below professional standards, the auditor could face serious consequences. Professional censure, sanctions from their institute, and potentially legal action from the homeowners for damages caused by relying on a misleading financial statement.
Their duty goes beyond just checking the math.
Definitely. Their duty of care includes ensuring the figures presented accurately reflect the financial health and that the association is meeting its regulatory requirements.
Okay, what about the fourth deficit? This one seems to address the elephant in the room in many associations, conflicts of interest.
Right. Number 4, no related party disclosure. The law, under various acts, generally requires the disclosure of any payments made to vendors, contractors, or agencies that have a relationship with any of the MC members.
What kind of relationship?
Could be family, personal friendship, or another business connection.
Yeah.
This disclosure is mandatory, specifically to prevent self-dealing or, the MC favoring their cronies with lucrative contracts funded by homeowners.
And the lack of this disclosure here means?
It means homeowners cannot exercise their fundamental right to check for potential conflicts of interest or the misuse of position for private gain. It hides potentially inappropriate dealings.
Okay. And finally, the fifth structural issue, which goes back to mixing different types of money.
Yes. Number 5, improper fund combination. The report states that maintenance receipts, which are basically day-to-day operating income, were improperly combined with capital inflows, like maybe one-time deposits or asset fees.
Why is that a problem? Income is income, right?
Not quite. Think of it like this. If your actual operating income for the year for maintenance fees is 80 lakh, but you mix it with 20 lakh you got from, say, a special capital levy or some other one-off inflow, your total revenue line magically looks like 1 crore. This fundamentally obscures the required segregation of funds between operating and capital. And critically, it artificially inflates the financial results. It can make the association appear operationally profitable when, in fact, its core maintenance services might be running at a deficit, subsidized by capital money.
Another way to mask the true financial health. This detailed audit critique, it wraps up by hitting on major accountability failures, what it calls the compliance void. Beyond the internal accounting chaos, what mandatory statutory obligations did the auditor just fail to confirm compliance with?
This failure potentially touches multiple regulatory bodies, which is serious. The auditor apparently failed to confirm mandatory compliance across several key areas.
Such as?
1, income tax filings. Are they up to date, compliant? Failing here exposes the association to fines and scrutiny from the tax authorities. Okay. 2, Societies Registration Act, Karnataka Cooperative Act standards. These acts have specific rules about how accounts should be kept and funds managed for registered bodies like RWAs. The audit didn't confirm adherence to these legal standards.
And 3, this seems critical given the context.
3, RERA AWHO obligations. Compliance with the requirements of the Real Estate Regulatory Authority, or perhaps the Army Welfare Housing Organization, if applicable, regarding the proper maintenance and handover of common funds and areas. These aren't just suggestions. These are legal mandates designed to protect owners. The audit didn't verify compliance.
So potential trouble with tax authorities, the society's registrar, and RERA, that's a lot of non-compliance risk. And finally, the report flags the dangerous concentration of signature authority.
Yes, it notes that only the president, the secretary, and the treasurer are authorized signatories on the account.
Just 3 people.
Just 3. And, crucially, there seems to be no requirement for countersignature from, say, an internal auditor or even a designated homeowner's representative, the very people who should ideally be providing a check and balance on spending.
So just 3 signatures needed to move potentially large sums?
Apparently. This concentration of authority, especially when combined with the lack of transparency across those 40-plus FDs and the opaque fund movements we discussed, well, it creates a significant vulnerability. Only 3 people need to collude, potentially, to facilitate unauthorized transactions or even divert funds without any immediate built-in checks.
Okay, so that culture of opacity, the concentration of power, the formality audit, it all provided the perfect cover, it seems, for the most dramatic finding in these reports. This illegal alienation of a community asset.
The land sale.
The land sale. This happened 12 years after owners had already taken possession of their properties, and it was apparently facilitated by the MC itself. We really need to forensically detail the initial setup. How did this land become common property in the first place? Because that seems to be the absolute foundation of the legal claim here.
Right, the history is critical. And this narrative, you really need to understand it chronologically to grasp the injustice. Initially, way back, there were 8 specific allottees, individuals who were designated to receive adjacent or maybe ancillary plots of land within the complex.
Okay, 8 specific buyers for 8 specific plots.
Yes. However, for whatever reason, those 8 individuals failed to actually pay the required price for those specific plots they were allotted.
So they defaulted, essentially, didn't complete the purchase.
That seems to be the case. So the builder was left holding these 8 unpurchased plots of land within the developed complex.
Okay, what happened next? What was the crucial step that transformed this effectively private land the builder still held into community property?
This is the key move. The builder took those 8 plots, removed them from being designated for individual sale, and officially reclassified them as common area.
Reclassified them. So legally, they were no longer available for private sale to anyone.
Correct. They became part of the shared common infrastructure of the apartment complex. But here, and this is absolutely critical, here is the mechanism of the initial burden shifting to the community.
How did the community get involved financially?
The cost associated with those plots, maybe the land cost, development cost, was then loaded into the common area cost, burdening all 78 owners.
Wait, let me make sure I understand this, and you, the listener, grasp this financial maneuver. The builder didn't just designate it common area.
Yeah.
The cost of those plots was effectively rolled into the total project cost that determined the price or the common area maintenance charges for all the other 78 homeowners.
That's exactly what the analysis indicates. The entire community of 78 owners essentially funded the inclusion of that land into the common pool, likely through their purchase price calculations or subsequent common area levies.
So the community collectively paid for that land to become common property. It wasn't a gift from the builder. It was subsidized by everyone else.
Precisely. This legally transferred the beneficial ownership of that land to the collective RWA. It became a community asset, paid for by the collective corpus, and legally dedicated for the community's benefit.
And it stayed that way for 12 years.
Yes, for the next 12 years, it was treated and maintained as common area, subject to all the rules governing common property in such a complex. It was trust property.
Okay. Then, fast forward 12 years, the same 8 original individuals, the ones who failed to pay initially,
Yes, the very same ones.
were somehow allowed to buy back those exact pieces of common land. Given the 12-year gap in what must have been an appreciating property market, what was the mechanism of the pricing fraud alleged here?
The alleged fraud was remarkably simple, almost brazen. They were allowed to pay the old original allotment rate from 12 years prior.
The 12-year-old price,
Right.
not the current market value.
Exactly. Not the contemporary market value. In 12 years, especially in many Indian property markets, the land value could have easily appreciated 5-fold, 10-fold, maybe even more.
So the MC facilitated a sale at a massive, massive discount.
Effectively, yes. By allowing the sale at the historic price, they transferred the entire difference, all that market appreciation built up over 12 years, directly from the community's collective pocket into the pockets of these 8 specific purchasers.
So let's be crystal clear. These 8 owners who initially failed to buy the plots got to capture the entire market appreciation over 12 years, even though the rest of the community had subsidized the land's transition into common property in the first place.
That's the essence of the allegation. It's a pure, unadulterated transfer of wealth of value directly from the community corpus to these 8 individuals.
This is just, wow. A clear diversion of community assets seems like an understatement.
It really does. The community funded the asset. They paid for its maintenance, implicitly as common area for over a decade, and then they were completely deprived of its inherent market value when it's finally sold off.
And the legal memorandum calls this.
It rightly labels this a textbook pattern of unjust enrichment, specifically calculated over that 12-year window. Think about the numbers. If the difference between the original rate they paid and the actual market rate 12 years later was, let's just say hypothetically, 1 crore in total for the 8 plots,
Yeah.
then the community lost 1 crore in cash value that should have rightfully entered the RWA's corpus fund, benefiting everyone.
Okay. Now, how did the MC and the builder allegedly cover this up on the books? Because selling common land is a huge red flag. This is where the accounting fraud seems to have become the crucial means of concealment.
Right. The concealment was cleverly, or perhaps deceitfully, tied to a separate pre-existing liability the builder had towards the association.
A different issue altogether.
Yes. The builder apparently had failed in its separate legal obligation to hand over the fully funded, legally mandated corpus fund to the association upon the project's completion and handover. This is a standard requirement under RERA or similar regulations.
So the builder owed the RWA a chunk of money anyway, completely unrelated to this land.
Correct. This was an outstanding debt, money the builder legally owed to the association for long-term maintenance and upkeep.
Okay, so how did they link this outstanding debt to the undervalued land sale?
According to the analysis, the MC basically acquiesced, they agreed, to use the proceeds from this undervalued land resale as a kind of surrogate or an offset to clear this outstanding corpus fund obligation owed by the builder.
Let me see if I follow. The builder collected the too low payment from the 8 buyers for the land.
Yes.
And then handed over part of that money to the RWA, but claimed that this payment satisfied their separate, much larger debt for the corpus fund.
Essentially, yes. It was like saying, okay, I owe you euro for the corpus fund. Here's I from selling your land cheap, and we'll call it even or partly even.
Wow. And how is this specific inflow of cash recorded in the RWA's books? This is the critical accounting part.
This is the core of the alleged cover-up. The MC accepted 52 lakh from the builder related to this land transaction. Crucially, however, they improperly recorded it in their books.
How did they record it?
Because recorded it as a refund of project money.
A refund. But it wasn't a refund. It was proceeds from selling an asset, or maybe an adjustment against a debt owed by the builder.
Exactly. It was absolutely not a refund of project money coming back to the RWA. This is the alleged accounting misstatement, the potential fraud. By calling it a refund, they completely mischaracterized the entire nature of the transaction.
And why would they do that? What did that achieve?
It achieved concealment. It hid the fact that valuable common land had been sold off at a throwaway price. It hid the fact that these proceeds were being used to let the builder off the hook for their unrelated corpus fund debt. It prevented homeowners, looking at the basic accounts, from easily tracing the source of the 52 lakh or understanding the true nature of this asset alienation. It buried the real story under a misleading accounting label.
Okay, so this tangled web of governance failures, the opaque finances, the land sale, the accounting trickery, it's all led to what the reports bluntly call the ugly legal situation. Let's start by firmly establishing the fundamental legal principle that was violated by selling off that common land.
Right. The core violation here is rooted deeply in property law and, importantly, trust law.
Trust law. How does that apply?
Once those plots were officially reclassified as common area, and especially because the entire community effectively subsidized their inclusion, that land ceased to be private property the builder could just deal with. It became trust property.
Held in trust for whom?
Held in trust by the association, or initially the builder, then the association, for the collective benefit of all 78 owners. The legal principle here is pretty much absolute in most frameworks governing community properties.
And that principle is?
Common property, once legally designated, often paid for collectively, cannot be unilaterally alienated, meaning sold or given away by the builder after the residents' association is formed and takes charge.
The builder loses the right to sell it.
Correct. And furthermore, the MC, acting as the trustees for the homeowners, lacks the unilateral power to divest, to get rid of such a critical community asset. They can't just decide to sell it off.
Not without following very specific procedures.
Exactly. Any such move would require, at minimum, strict statutory authority, meaning the law must explicitly allow it, usually a heightened quorum and consent from the owners, far beyond a simple majority, and crucially, fair compensation based on the contemporary market value at the time of sale, none of which appears to have happened here.
So let's be really clear. Even if the MC had brought this land sale proposal to a general body meeting, a GBM, and somehow managed to get a simple majority vote to approve it, that action would likely still be legally void. It wouldn't cleanse the transaction.
Correct. That's a critical point. The verdict from the legal analysis we have is unambiguous. The resale to those 8 original owners at a throwaway historic price is prima facie ultra vires.
Ultra vires meaning beyond the legal powers of the MC as trustees.
Precisely. And it's also profoundly inequitable. A majority vote in a GBM cannot legalize an act that is fundamentally illegal or fraudulent. It cannot authorize the confiscation of common property rights from the minority or from the collective corpus without proper procedure and fair value.
An illegal act remains illegal, regardless of internal approval, especially when it violates fundamental property and trust principles.
That's the core legal position.
Okay, let's break down the specific liability exposure now for each party involved in this mess. Starting with the management committee, the MC, and by extension, the association they represent. Their primary failing seems to be a massive breach of fiduciary duty.
Massive is the right word. The MC members especially, the key office bearers like the president, secretary, treasurer who signed off, and anyone else on the committee who actively consented to this, they failed spectacularly in their duties of loyalty, care, and prudence.
How so, specifically in this context?
Consenting to an undervalued transfer, a deal which effectively gifted 12 years of market appreciation away from the community they were supposed to protect. That's a huge breach of loyalty. And then, actively misstating the receipt of the $52 lakh payment to cover up, that goes far beyond mere negligence or a simple mistake.
The legal memo had strong words for it.
It did. It called it an act so egregious it raises a strong presumption of collusion or gross breach of loyalty. The language is stark because the breach appears so blatant.
Okay, what are the concrete, real-world consequences for the MC members themselves? Not just the association being sued, but the individuals. We touched on personal liability earlier.
Their personal exposure here is very high, potentially life-altering. First, you have regulatory action. The Registrar of Societies, once alerted, has the power to step in, order a formal inquiry, and potentially even dissolve or supersede the entire MC, appointing an administrator.
Okay, regulatory intervention. Second,
civil liability. The RWA itself, likely through a new responsible leadership or an administrator, will almost certainly sue the old MC members personally to recover the financial losses incurred by their breach of duty. They'll be seeking the full value lost on the land sale.
And third, the really serious one.
Third, the very real potential for criminal charges. We're talking about things like falsification of accounts for the $52 lakh entry, criminal breach of trust for mismanaging trust property, and possibly even conspiracy.
And if they deliberately misrepresented that payment and knew the land sale was improper?
Then they absolutely cross the line from mismanagement into willful misconduct, potentially criminal intent. And that, as we discussed, is exactly how the corporate veil, protecting them as individuals, gets pierced. If their actions are shown to have personally benefited them or were grossly negligent towards the beneficiaries, the homeowners, those officers become personally liable to repay the community's losses from their own pockets.
Okay, that's the MC. Now, moving to the builder. What's the extent of their liability? They were the ones who actually physically executed the sale deed for the land, right?
Yes, they executed the deed, but their liability centers on the fact that it was an ultra-virus disposal. They sold land that they had previously legally dedicated as common area, land for which the community had already paid the embedded cost.
So they didn't really have the right to sell it anymore?
Legally, no. Their power to sell that specific land arguably evaporated the moment it was formally reclassified as common area and its cost was loaded onto the 78 owners. This makes the sale itself voidable ab initio.
Ab initio meaning void right from the very beginning.
Exactly.
Yeah.
As if it never legally happened, regardless of the piece of paper called a sale deed. The deed was based on a power the builder no longer possessed for that specific property.
Okay. And what about their attempt to use the proceeds from this dodgy sale as an offset for the separate debt they owed for the corpus fund?
That's viewed as an unlawful set-off in the legal analysis. It's essentially an attempt by the builder to clear a legitimate debt they owed to the RWA by using money derived from the illegal undervaluation of the RWA's own asset.
Robbing Peter to pay Peter using Peter's money.
That's a pretty good analogy, actually, yes.
This maneuver gravely distorts the RWA's accounts and causes direct financial harm to every single owner who didn't explicitly consent to this arrangement.
So the builder's exposure is?
Massive civil liability, for sure. They'd be liable for restitution, meaning paying back the full market value difference and potentially a full accounting for the illegal transaction. Plus, given the apparent intent to hide their own pre-existing debt through the scheme,
there's serious criminal exposure for them as well. Charges like cheating, Section 420 of the Indian Penal Code, and criminal breach of trust, Section 406 or 409, seem highly relevant. They took property held in trust and disposed of it improperly, seemingly to benefit themselves by clearing their debt. That's classic criminal breach of trust territory.
Okay. Finally, let's analyze the position of the 8 purchasers. The ones who got the land cheap. They paid money, they got a sale deed. But the legal memo suggests they are facing perhaps the most acute risk centered around the concept of unjust enrichment.
They are in a highly precarious position, legally speaking.
Yeah.
They cannot easily claim the usual protection afforded to good faith purchasers who buy something without knowing about any underlying illegality.
Why not? Why wouldn't they be considered innocent buyers?
Because the circumstances strongly suggest they weren't entirely innocent or ignorant. Firstly, they benefited from what the memo calls a known preference. They were the original individuals who failed to pay years ago. Secondly, they acquired the property 12 years later at a price they absolutely knew, or certainly should have known, was dramatically undervalued compared to the current market. A deal that could raises red flags.
Willful blindness isn't a defense.
Exactly.
Yeah.
And thirdly, they likely knew, or should have known, that the land had been classified and used as common property by the entire community for over a decade. Ignorance of the complex legal specifics might be one thing. Willful blindness to an obviously preferential, deeply discounted deal involving former common land is quite another.
So the core civil claim against them is unjust enrichment. They got the benefit, the 12 years of market appreciation, entirely at the community's expense.
Correct. That's the central civil claim. They are liable, at minimum, to disgorge that unjust enrichment. That means paying the difference between the ridiculously low historic price they paid and the actual market value at the time of the illegal resale, plus substantial interest, back to the RWA.
They might be treated as holding the land or its value in trust for the community.
Yes, the concept of a constructive trust could be imposed by a court. They become trust of trustees, legally obligated to return the benefit they shouldn't have received. But the analysis flags what it calls the ugliest outcome for them.
Which
is the court deciding not just to make them pay the difference, but declaring the original sale completely void.
Voiding the whole transaction. Let's dedicate some time to explaining the mechanism of reconveyance. If a court grants this primary remedy, what does that process actually look like for these 8 owners?
Okay, reconveyance is a powerful remedy. If a court grants it, it typically does so by issuing a declaratory decree.
A declaration by the court?
Yes. This is a formal judgment that essentially declares the sale deed they received 12 years ago null and void. It wipes it out legally. The basis for this declaration would be that the sellers, the MC, and the builder lacked the fundamental legal authority to alienate that specific property in the first place. The transaction was ultra vires.
How does the association get this decree?
The association, or its representative, would file a civil suit specifically seeking this declaration. In court, they would need to prove the key facts: that the land was indeed common property, that its sale was beyond the powers of the MC and builder under the relevant laws and bylaws, and critically, that the 8 purchasers were not innocent good faith buyers without notice of the irregularities.
And if the court agrees and issues the declaratory decree, what happens then?
The legal title to the land is effectively reverted back to the association. The land becomes common property again, legally owned by the collective.
And the 8 purchasers, they lose the land?
They lose the land entirely. The sale is undone. They would likely have a claim to get back the original historic purchase price they actually paid 12 years ago, though maybe less certain depending on circumstances. But they would forfeit all the appreciation in value over those 12 years, and crucially, they lose the asset itself.
That's why it's the ugliest outcome.
Absolutely. They took a huge gamble, assuming a massive risk of the title being declared void, by participating in a transaction that was, on its face, so clearly inequitable and legally questionable. Their entire investment in that specific piece of land could be completely nullified by a reconveyance order.
Okay, the situation is clearly dire, a catastrophe, as you called it earlier. It obviously requires aggressive, well-documented action from the homeowners. And as the source material rightly emphasizes, the crime or illegality does not become lawful by passage of time or by silence. You can't just ignore this.
No, silence is acceptance in a way legally detrimental.
It sounds like it requires a strategic, multi-track approach, one that uses both internal accountability measures and external legal pressure simultaneously. Let's start with track 1, immediate governance and accounting corrections. This is the internal focus, getting the house in order and finding the facts.
Right. The absolute priority here is establishing irrefutable, independently verified facts about what happened. The first necessary step, according to the recommendations, is for homeowners to requisition a special general body meeting, SGBM.
An emergency meeting, basically.
Yes, and this SGBM needs to have one clear, non-negotiable mandate: the appointment of an independent forensic auditor, not the previous auditors, not someone connected to the current MC. Truly independent.
And this can't be another formality audit.
Absolutely not. This needs to be a deep dive.
What specific scope must this forensic audit cover to actually build the legal case and understand the full extent of the damage?
The scope needs to be quite surgical, very specific. The forensic auditor needs to. 1, examine the entire history of that land reclassification, who paid what, when, how the cost was loaded, get the full paper trail. 2, analyze the economic justification or lack thereof for using the historic pricing 12 years later versus the contemporary market valuation at the time of sale. Quantify the loss. 3, trace the precise trail of that 52 lakh payment from the builder. Where did it originate? Which account did it go into? How was it moved? And crucially, document how it was ultimately misclassified as a refund of project money.
Nail down the accounting fraud.
Exactly. And 4, they must quantify the total remaining corpus fund shortfall still owed by the builder, even after accounting for the 52 lakh, to establish the full extent of that separate breach.
So this forensic audit essentially provides the verified evidence base for all the subsequent legal actions.
Precisely. It's the foundation. And simultaneously, while that forensic audit is commissioned, the SGBM must address the existing financial messes that were identified back in Section 2.
Like the opaque FDs and commingled interest.
Yes. The SGBM must mandate an immediate formal restatement of accounts. They need to correct that misclassified eerily lack payment right away, remove the accounting cover-up, and record it accurately for what it actually represented. Likely proceeds from asset alienation being improperly used as an adjustment against the builder's separate corpus fund liability.
Get the books to reflect reality.
Yes. And furthermore, they need immediate, robust oversight reform to stop this happening again.
What kind of structural reforms are necessary to prevent this culture of opacity from just returning once the immediate crisis passes?
Well, the source strongly recommends establishing a homeowner finance oversight subcommittee. This can't be a puppet committee. It must be composed of genuinely independent representatives, maybe homeowners with finance backgrounds, who are given explicit authority and access to review bank statements, vouchers, and contracts before payments are made.
Real-time oversight.
Yes. And crucially, they must mandate the immediate creation and transparent sharing of that comprehensive FD register we talked about.
The list of all 40-plus FDs.
Right. It must detail, for every single FD, the maturity date, the specific fund it belongs to, corpus, sinking, project, whatever, the interest rate, and the documented authorization details required for premature closure or renewal. This transparency kills the opportunity for hidden closures or round-tripping.
Makes sense. And what if the current MC, the oligarchy, tries to block all of this? If they stonewall the SGBM or the forensic audit?
Then the homeowners must be prepared to use the mechanisms available in their bylaws. That could mean pursuing fresh elections to vote the current committee out, or potentially initiating a no-confidence motion if the bylaws permit. They need to install a committee that is actually willing to act as genuine trustees, not as obstacles.
Okay, that covers the internal track. Now, let's move to track 2, civil remedies. This track focuses on direct recovery, getting the money or the land back from the liable parties. What's the necessary first legal step here?
The first formal step is issuing a professional, firm, legal demand notice. This isn't just an angry letter. It's a formal legal document drafted by lawyers.
Who gets this notice?
It must be sent immediately and simultaneously to both the builder and all 8 of the purchasers who received the undervalued land.
And what does the notice demand?
It should clearly outline the illegalities, the ultra-vires sale, the breach of trust, the unjust enrichment, and offer a very limited window, maybe 15 to 30 days, for a pre-litigation resolution. The core demand must be stark and offer 2 alternative outcomes.
Which are?
Either option A, the immediate reconveyance of the land parcels back to the association, essentially undoing the sale completely. Or option B, the immediate payment of the differential value.
Meaning the difference between market value and what they paid?
Exactly. The full market value at the date of the illegal resale, minus the historic price they actually paid, plus substantial punitive interest calculated over the intervening years, with the entire sum to be paid directly into the association's corpus fund.
Make the community whole financially if the land isn't returned, and if they refuse to settle, if they ignore the demand notice.
Then the association must be prepared to immediately proceed to court by filing a formal declaratory and recovery suit.
Okay, but we have to address the big legal defense they're almost certain to raise, the statute of limitations. This sale happened 12 years ago. How does the RWA possibly overcome the argument that it's simply too late, that too much time has passed to challenge the transaction?
This is undoubtedly the biggest legal hurdle, and overcoming it requires very strategic legal framing in the lawsuit. The defense will argue that the limitation period, typically 3 years for many types of suits in India, has long expired.
So how does the RWA counter that?
The legal team to the RWA needs to deploy specialized legal doctrines to argue why the clock hasn't run out or why it should be restarted. There are 2 main arguments suggested by the analysis.
What's the first?
First, they can potentially argue the continuing wrong doctrine. The argument here is that the harm to the community isn't just the sale itself 12 years ago, but the ongoing illegal possession and occupation of what should be common area. As long as the title wrongly remains with the 8 purchasers, the wrong is continuing day by day.
So the clock keeps resetting.
That's the argument, though it can be complex to win on this alone. The second argument is likely stronger.
And that is?
The more powerful argument is to frame the entire case around the concept of trust property. As we discussed, the land was essentially held in trust for the 78 owners. There's a well-established legal principle, often codified in limitation acts, that generally the statute of limitations does not run against a beneficiary seeking recovery of trust property from a trustee or someone who wrongly received trust property.
Especially if there's fraud or misconduct involved.
Exactly. The limitation periods are often much longer or don't start running until the beneficiary becomes aware of the breach, especially in cases of fraudulent breach of trust. By arguing that the MC breached its trust, and the 8 purchasers are effectively constructive trustees who participated in or benefited from that illegal alienation of trust property, the association can strategically neutralize the standard limitation defense. This approach allows them to pursue the primary remedy of reconveyance, getting the land back, even after many years, by framing it as recovery of misappropriated trust assets.
Okay, that's the civil track. Finally, let's look at track 3. Regulatory and criminal pressure. These often seem like the high-leverage steps, the ones that can sometimes force the builder and maybe even the culpable MC members to the negotiating table much faster than waiting years for a civil suit to conclude.
That's often true. The regulatory route, in particular, is usually lower cost and leverages the power and authority of the state agencies responsible for oversight.
So what's the first regulatory step?
First, file targeted, well-documented regulatory complaints. These should go to the Registrar of Cooperative Societies, or the equivalent body under the State's Apartment Ownership Act.
And what should these complaints focus on?
They should clearly cite the ultra-vires alienation of common property and the MC's profound fiduciary breach in facilitating it and covering it up. The goal is to request the registrar to launch an official inquiry or investigation into the affairs of the society.
Does the registrar have the power to investigate based on the audit failures alone?
Yes, absolutely. The source material explicitly points out that a registrar-directed inquiry under Section 64(2) of the Karnataka Cooperative Societies Act, or the equivalent section in other state acts, is specifically warranted here, just based on the documented audit failures and financial mismanagement alone.
What can Section 64 achieve?
That section grants the registrar the power to initiate inquiries into the constitution, working, and financial condition of a society, often triggered by audit reports showing deficiencies or complaints about serious mismanagement. A formal inquiry ordered by the registrar carries significant weight and can mandate immediate corrective actions, potentially including superseding the MC.
Okay, so complain to the registrar. What about RQRA?
Definitely. A separate complaint must also be filed with the state's Real Estate Regulatory Authority, RERA. This complaint should focus on 2 things.
1.
The builder's original failure to hand over the legally required corpus fund upon project completion, that was the initial debt they tried to improperly offset.
And 2.
And their subsequent involvement in the illegal alienation and use of common areas, the land sale. RERA has powers to impose significant penalties on builders for non-compliance with their obligations regarding common areas and fund handovers.
Okay, registrar and RERA. Now for the most aggressive path, the one with potentially the highest leverage, the criminal route. This is where personal liberty is potentially at stake for the individuals involved.
Yes, the evidence detailed in the report strongly suggests that pursuing the criminal route concurrently with the civil and regulatory tracks is warranted and potentially very effective.
How is this initiated?
It can be done in 2 main ways. either by filing a formal police complaint seeking the registration of a First Information Report, FIR, or, if the police are unresponsive, by filing a private complaint directly before a judicial magistrate.
And what specific criminal charges would be cited?
Based on the allegations, the complaint would likely cite sections of the Indian Penal Code related to criminal breach of trust, Section 406409, cheating, Section 420, potentially conspiracy, Section 120B, and specifically falsification of accounts, Section 477A, regarding that 52 lakh entry.
Now, criminal cases require proving mens rea criminal intent. That's often harder than proving negligence in a civil case. How would the RWA demonstrate intent here?
It's challenging, but the evidence of intent seems layered in this case.
Yeah.
You have, one, the fact that the land sale was so massively undervalued, suggesting it wasn't an honest mistake.
Yeah.
Two, the specific use of the proceeds to improperly clear the builder's unreloaded pre-existing debt, suggesting a motive beneficial to the builder and potentially the MC.
And the accounting entry.
Three, the deliberate falsification of the accounting entry, labeling the 52 lakh as a refund when it clearly wasn't. That specific act strongly suggests an intention to deceive, to cover up the true nature of the transaction.
So the combination of these factors points towards?
It points towards a concerted effort, potentially a conspiracy, or at the very minimum, intentional dishonesty designed to benefit certain parties at the expense of the community. This layered evidence helps build the case for the mens rea required for charges like cheating or criminal breach of trust.
And why run this criminal track parallel to the civil suit?
Because it acts as an incredibly powerful catalyst for settlement. Facing potential criminal charges, arrest, and even jail time puts immense personal pressure on the culpable individuals within the MC and the builder's organization. This personal jeopardy often brings parties to the negotiating table for the civil claim much faster and more seriously than just the threat of a monetary judgment years down the line.
So the ultimate goal of all these tracks, the fair resolution here, it's not about finding some middle ground or compromise, is it?
No, not based on these facts. The goal must be full restoration of the community's rights and financial standing. Meaning either the reconveyance of the land title back to the association, making it common property again, or the full recovery of the market value lost, the differential plus substantial interest, paid back into the association's corpus.
And the cost of achieving this restoration, who pays?
The cost must be financed entirely by those who improperly benefited from the illegal transaction. Primarily, the builder and the 8 purchasers. The community, the victims here, must be made whole financially for the 12 years of lost appreciation and the loss of the common asset itself. Anything less would essentially ratify the original breach of trust. Hashtag outro, Frower.
Wow. This has been an incredibly deep and frankly quite alarming look into the VVARWA situation. Let's just quickly synthesize the two really interconnected crises that we've uncovered through these documents.
Yeah, they really feed into each other. The first crisis is that systemic collapse of governance. It seems fueled by this entrenched oligarchy that was actively hostile to any real oversight.
Right.
And that culture allowed the MC to basically ignore its statutory duties, facilitate these opaque formality audits, essentially creating an environment where multi-core funds were vulnerable, and just following the law was treated as some kind of option, not a fundamental obligation.
Okay, that's crisis 1, the governance failure, and the second crisis.
The second crisis is the direct, tangible result of that toxic environment. It's the specific, apparently illegal act of alienating valuable common assets, that land which had appreciated for 12 years, and then masking that alienation through a deliberate accounting fraud that 52 lakh misstatement used to improperly let the builder off the hook for a separate debt. It's just a shocking display, really, of alleged self-dealing and a calculated confiscation of the community's collective wealth.
And that negligence, that potential collusion, it has very concrete, very serious legal consequences, as we've detailed. It just underscores the fact that legal obligations for an RWA, for an MC, they aren't negotiable.
Absolutely not. And homeowner oversight. It isn't some inconvenience or an irritant for the MC to ignore. It is a fundamental right. It's backed by laws like the Societies Registration Act, the Cooperative Societies Act, Apartment Ownership Act.
Laws designed to protect the owners.
Exactly. And failing to mobilize now, for the homeowners in this situation, it risks regulatory sanction against their own association. It risks the permanent forfeiture of community rights and assets, and it basically leaves the door wide open for continued malfeasance.
The sheer complexity we've unpacked here, the accounting fraud layered on top of the property law violation, all stemming from a broken governance culture, it really shows that managing common assets, especially when dealing with large capital sums, isn't simple. It's a continuous, sophisticated struggle. It demands eternal vigilance from the members.
It really does. And maybe the final thought for you, the listener, is this. The documents we review today, they underscore a frankly terrifying possibility that in many community associations, maybe even yours, crores of owner funds could be being handled without proper statutory authority, maybe without adherence to basic legal principles, and sometimes, it seems, without any kind of moral compass guiding the managers.
That's a chilling thought.
It is. The risk highlighted here is that the very body entrusted by law and by election to protect your assets, your home's value, could actually be operating outside the bounds of the law that's supposed to govern it. So you must remain vigilant. You have to ask the questions, demand the transparency, scrutinize the accounts. Because, as this case seems to show, the cost of silence, the cost of apathy, can be measured in lost assets, lost rights, and years of financial opportunity confiscated by the very people you elected to protect them.
A compelling and, yes, deeply sobering conclusion to draw from this VVARWA case. Thank you for diving deep with us today and navigating through this complex legal and financial maze.
Thank you. It's crucial information for homeowners everywhere.